Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. We've got our favorite guest back for round three. People have been asking me, been hitting me up on X. They've been saying, when's this Shubham interview coming out? We had a few little delays, but guess what, guys? Live and direct. We're here. We're getting it done. We're going to talk about the oil market today. Briefly, if you do like and enjoy the content, be sure to subscribe and like to the YouTube channel. Drop me a comment. It helps with the old algorithm. And today's podcast is brought to you by the options publication that I run, the Maverick Life. It's about my project creating an upper class income from minimal investment through the power of options, geo arbitrage, and all sorts of other tricks. Link will be in the description. Check it out if that sounds interesting to you. And disclaimer, of course, guys, nothing we say here is advice. It's just two cowboys talking about the oil market, which we love. So by all means, read the disclaimer and make sure you take responsibility for your own investment decisions. So with that, it is my pleasure to introduce the man back onto the podcast, Mr. Shubham Garg, White Tundra Investments. All his links will be in the description, of course. Mr. Garg, how are you, sir? Where are you and what's happening?
Good. It's been a while, Ben. Lots has happened in the oil markets over the summer. I think many of us are surprised at how fast 2023 has gone. There was sort of this a waiting of when the markets were going to turn, what was going to happen. We saw very historic lows in the positioning data. We saw some lull in the markets, and then some obviously some major decisions by OPEC plus led by Saudi. So it's been a very interesting market, I would say, overall. Lots of changes, lots of structural changes going forward. I'm sure we'll get into this here as we go on, but so everything else is doing great. Enjoying my life here in California. It's been I just had my 1 year anniversary, so
Congratulations.
1 year anniversary of living in California, I should say.
To be clear.
Yeah, to be clear. And yeah, things are great. I'm talking to you live here from a Mustang Shelby GT burning gasoline as I'm idling. So it's 118 Fahrenheit. So
Oof.
we're it's like being in Saudi Arabia, which I don't mind as long as the API reports keep coming out as they are. So life's good. Yeah.
Life's
And
good.
thanks for
Very
having me on.
typical. I love it. No, my pleasure. And so we're going to talk about a little bit of macro update, and then we're going to do a little bit of a deep dive into particularly two companies that you and I both have keen interests in. We're going to talk about Surge Energy, PPR, and then a list. We'll do a rapid fire of some of the other interesting names in the sector, and then I'm going to brag about Petrobras. So here's a pinned tweet from your account. This is important because I think the narrative that was, or one of the narratives that was holding the oil market back was the idea that we could simply just turn on the shale tap and that would simply override any OPEC cuts or any increase in demand that was unexpected. And since you've posted this tweet, run me through just briefly what we're seeing happening with regards to shale, the shale patch, and why that's important to this narrative that, hey, it doesn't really matter if we get strong draws because shale can just simply come back online and we can meet that demand, no worries.
Right. Yeah. No, I'm glad you picked this one because this was very timely in that this tweet was sort of before the price really ran up back into the 80s, high 70s, low 80s, I should say. And really, the big structural change is we're seeing this narrative, as you said, that okay, as prices rise, we're going to see supply being again added to the market, right? Okay, it happened in 2022, so why can't it happen again? Part of the reason that narrative doesn't hold true is the fact that the DUC wells just aren't there in the shale patch. The fact that every year that's now going by, the well productivity continues to drop. And we're seeing a lot of the private equity players have gone bought out. So in 2021, 2022, even in the first part of 2023 here, some of the major growth players on the private side that were growing and adding to production have been bought out. So, okay, what's going to happen? Well, people are a bit scared. They're saying, okay, price is going to run up and then maybe I should sell. because all this supply is going to get added to the market again, and then maybe I can get a chance to rebuy. What we're seeing is the opposite of that. So as the prices have risen, you're seeing that the production hasn't ramped in the US. And in fact, the numbers here show 10% down drilling rigs year over year. And now we're probably 2 months after this tweet came out, roughly. And we're now at about 15% down year over year. And the frac spreads are down more than 15%, I want to say, year over year. We're at 246 now. We're about 289 last year. So roughly 15% there. And then the well productivity, we don't have the exact numbers for 2023 updated, but it's roughly in that 10% range down year over year. So really the big narrative has been overturned. When I post this graph, I usually get a pushback that, hey, when I see the purple line for 2023 and I see the black line for 2022, we're still about 700K or 800,000 above that line, meaning we have that growth. And that's a completely fair point, but that's not how this graph should be read. The way you should read this graph is look at how many months the US production has been flat. So when we look at something like in this graph, September, October of 2022 to where we are today, you see about 8 to 10 months of a flat line. And that's essentially the line we're on now. Once those DUCs got exhausted, once the $100+ oil has kind of subsided, we're now in our regular range. And we're not seeing growth. And then in the last 2 months, prices 75, 80, there was a bit of concern that rigs would start rising. And again, the opposite has happened, where not only have rigs not risen, we're still losing about 7 rigs a week. So 1 rig per day. Some of it obviously is in the gas basins as that continues to get hammered. But for example, last week, the Permian rigs were down 7. So it's slowly bleeding into the entire sector. This mantra of just consolidation, longer term inventory management, more of just a stronger, more mature sector going forward. And this is going to be a very, very big point because 90, 95, 99% of the world still believes that shale is this on-off switch that can just pile back on. And more importantly, a lot of the money managers still think this way because Rystad, Inveris, and some of the other WoodMac analytics companies are saying the exact same thing. So we really need this narrative to taper down and for the data to prove it false so that some of the bigger managed money feels more comfortable coming back in. It's going to take time. So it's not going to happen right away. They're going to want to see a year of maybe no growth. They're going to want to see maybe 6 months at $90 oil of no growth. And then it really becomes a self-fulfilling narrative. And on the bottom of all of that is the fact that well productivity looks to be dropping somewhere between 5 to 10% every year. So it's not that, oh, we dropped in 2022 or 2023 and we're going to stay here. It's continually dropping every year. And that just has to do with inventory management and the fact that the best locations are always, in 99.9% of cases, the best locations are always drilled first. So that's just the reality of it. And a lot of the analysts are saying, hey, productivity is going to drop and then it's going to stay at this line. Well, that's not how it's going to pan out. We don't have that much inventory for it to stay that way, but we'll let the data do the talking, and I'll make sure to share as many of these graphs as possible here, maybe like 1 a month as the cycle goes on.
Certainly be interesting, yeah. And I think that understanding how shale works and that you pull forward, you front end load a lot of that production. It's not like an even scaled production. I think a few people are missing that particular point. And then, as you mentioned, the DUCs have been basically depleted as far as I'm aware. The drill rig count is coming down. At the same time, OPEC is cutting, and the Saudis seem pretty serious about holding line with regards to production cuts. For audio-only listeners, for your benefit, I'm showing a graph here, rolling 12 months. We've got the oil price itself, the futures. We've got the small caps, PSCE, XLE, of course, a very generic major cap index, and then the OIH. I've been talking about offshore for a long time. Looks like it's starting to get a bit of traction. When you look at this, what surprises you the most out of this, the performance of any particular subsector in the oil sector, and then with regards to the geopolitics surrounding supply and demand? Is there anything that's really surprised you since we last spoke?
Yeah, 100%. So just before I answer that, one more point on shale is you
Certainly.
talked about decline rates. What we're realizing as time goes on is not only is the wells front loaded on the production, but these companies are moving to longer laterals. They're moving to more proppant in these fracs. They're moving to tighter frac spacing. Uh, and what that's creating is you might get really good production up front, but as you get to month 6, 12, 18, 24, the decline rates now are even higher than they used to be. So as you have this base production, you would think, okay, adding a year's more of base, you should have a lower decline rate. But in essence, the decline rate of the entire tiramisu, let's say, by year is going up because of the front-loaded production and the fact that they're drilling longer and longer. Hey, this is a reservoir. You can only have so much pressure come out of the toe end of the well. And there's synergies, and then there's problems with the way that they're doing this. So just keep that in mind as time goes on. I had a post I made about the decline rates on my feed as well that I think we need to keep in mind as time goes on. And then on this chart specifically, I think we're seeing some of the re-rating that was projected to happen. We're saying, okay, WTI price itself looks like it's down, but the overall XLE index, which is primarily some of the bigger producers, but still, those bigger producers were already trading at a premium to the small caps, and now they have outperformed oil price even then. So I think it's a good sign, shows a healthy market. Some of it has to do with the buybacks that the companies are doing. Some of it has to do with their healthy dividends, that they're able to maintain this. And then some of it just has to do with the fact that the equities were trading at a very low WTI strip kind of comparison multiple. So there's naturally expected to be a bit of re-rating that happens in that. The other thing I see here is that the volatility has come down slightly. So when you look at big banks, when you look at the hedge funds, you look at equity, private equity, etc., they don't really like volatility. We as retail investors, we love it. We want to play options. We want to do short-term trades. We want to go in and out of stocks. It's a benefit in that sense. But the bigger boys, they want a little bit more stability than what we saw in 2022. I mean, 2022 was absolutely insane, the way the oil volatility was. So this more stable climate, I think, is very conducive, because the more familiar that the bigger money gets with this, the more happy they will be at allocating dollars towards it. And then I think services was just bound to outperform. We didn't know when that was going to happen. Like even if you look at this graph, for example, if you had invested in May here, you really outperformed the XLE. Whereas if you had invested, let's say, in February, you didn't really outperform. They're both kind of flat for that period. So a lot of this comes down to timing and what you pick as your kind of starting spot. But this opportunity is still existing out there. You're still seeing the opportunity that if you're willing to go in and make a concentrated bet on a sector, and you end up getting the timing right on it, you can wildly outperform the other indexes or even individual equities, for that matter, depending on obviously what you end up picking. So that's what makes these markets fun. We can discuss these things. That's why we have all these oil spaces and podcasts, because there's just so much thoughts and content out there to kind of share your different, very concentrated, very a detailed view on a certain part of the sector, and you're either correct or you're not. So the scoreboard is out there for everybody to see, and I think that's on the graph side. And then as far as what's changed on the macro, I really don't think much has changed. There was a belief in 2022 that OPEC was going to come to the rescue. They maybe took 3 months too long, but they came to the rescue as we thought was going to happen. There was a lot of narrative around, well, Saudi Arabia has no geopolitical power. They don't have any control of the situation. The countries are going to cheat, yada, yada. And yes, it all happened to some extent, but it's looking at the forest or looking at the trees. When you look at it on a whole, Saudi Arabia as the de facto head of OPEC is willing to take the brunt of the cuts on themselves, and is willing to push Russia into supporting them as well, given that those two combined make up somewhere between, I'm thinking, like 50 to 60% of OPEC plus production at this point. So I think that has come to fruition. it's taken a while longer to do the cut, and it's taken a while longer for those cuts to show up in the market. But looks like we're here now. And at the end of the day, we're not out here looking to become millionaires overnight. As much as that's what we all hope to do, there's a reason that doesn't happen in stock markets. As much as we all think we're gonna go out and absolutely kill the game and destroy everybody, the reality is there's not that many people who became multimillionaires overnight in the market. So it's more investing in the thesis at this point, investing in the cycle. And I'm very happy with the two major points of the cycle being accounted for. One being OPEC plus strength, and then the second being the shale growth mantra not existing anymore. And again, this is going to take time for people to appreciate this. It's going to take time for people to accept this. But I'm very happy with Saudi Arabia at the helm, because you can say, hey, there's a 5 million barrels of spare capacity, and so the market's not going to run, and make up all these things that may or may not happen in the future. The reality is they haven't added those spare barrels back to the market. So despite the move we saw in the last 2 months, so far they haven't added those barrels back to the market. So it's like saying, hey, why are you worried about buying a house? There's so many houses for sale. Well, yeah, there's houses for sale, but you're not going to get them unless you pay what the owner's asking for them, right? So yeah, you can say the market is flush with houses and whatnot, but it doesn't matter. So that's again, I think, where the forest for the trees, and I think again why, despite a lot of us having the same level of data, or at least very, very similar levels and quality of data, people are coming up with completely different conclusions because they're kind of letting their mind get biased. Bulls and bears included, I'll say. But so far, the data is showing that the bulls have been correct in terms of what's happened so far.
Yeah, I'm sure a lot of these draws that we see just continually coming out, certainly supportive of that. And when you take into account, let's say on the supply side, some of these hiccups that we spoke about off camera, they seem to be exhausted now. People weren't taking into account Iranian crude, and perhaps the US looking the other way as some of these storage tankers got a little lighter, let's say. SPR release is done. Russia just miraculously Russian crude kept showing up into the market. Those seem to be pretty much exhausted now, as far as I'm aware. I mean, maybe you can correct me. And then the Saudis seem pretty keen to continue their cuts, maybe into, who knows, Q1 next year. And then on the demand side, we just see these, like, it's almost like annual IEA upward revisions. If you're expecting peak oil, as I am, around, I don't know, 2040, 2050, I think we can afford to wait just a little longer, given we're only in 2023. I spoke with a mutual friend of ours, Josh Young, and we reviewed some of his work that was published in January, looking at potential supply and demand scenarios. To kind of wrap up the macro side here, where do you see us ending this year in terms of a surplus versus deficit, and by how much? Is this idea that we might be in a 2 million barrel a day deficit, is that crazy, or where do you see things as of now, August 2023?
Right. Yeah, I think the question that's on top of mind for everybody. So I guess I'll begin on some of the earlier points. So the Iranian floating storage and some of their onshore crude that got exported, and some of these barrels emptied, I think was one of the rain clouds, let's say, hanging over the market, that, okay, not only can Iran potentially increase production, but they got this X amount of barrels. The estimates went from 60 million to 120 million. It's still not clear what exactly the volume was, because some of it was crude, some of it was condensate, some got emptied out of onshore. So it was sort of a mishmash of factors, but essentially that rain cloud is now gone. And one of the interesting things that maybe some of the viewers may be aware of, they may not be aware of, is that a large part of Iranian crude floating storage and some of their condensate floating storage was already at the destination. So you had multi-millions of barrels sitting off the coast of China, and you had multi-millions of barrels sitting in Singapore that was already exported, and it was sitting there. So all you needed was China to allow those vessels to be imported, and all you needed was those barrels being spoken for out of Singapore for them to begin their actual journey from there onwards. So what it allowed Iran to do, and we can speculate, did the U.S. work with Iran to go and flood the market, whatever. The point is Iran was able to really get these barrels to their destination in record time, because half of it was already at China and then half was already in Singapore. So they was ready to get fired. That bullet was ready to get fired as soon as possible.
It wasn't as if they just produced these barrels miraculously and had this potential production power that people were not aware of.
Yes, it was already out there, and there wasn't a lag effect on it. So it was basically absorbed right away by the market, and it created that short-term drawdown that it did, because it was a significant amount of volume. There is 60 to 120 million barrels is a lot of volume if a market is like relatively in balance. So I think that's on the Iranian side. The Russian cuts so far look really promising, not only on the seaborne exports, but also on the pipeline exports, which are down about 15% from last year. So the pipelines that are going to China, the pipelines that were going into Europe, we've lost about 300,000 barrels of export there. Plus, now we've looks like the seaborne export number has come down tremendously. So that is something I track almost every second day or third day, I want to say. I look at the Russian export number, what's going on there. So far, so good. We will continue to track that. I think between Saudi and Russia are kind of your two major factors, obviously, that can add those barrels back into the market. So tracking those on a day-to-day or a multi-times a week basis just allows one to stay in touch with the markets at this point going on. And then, really what other bullets do we have? So we have Venezuela. Yes, they've added a couple 100,000 barrels in the last 3, 6, 9 months. Is it really that meaningful? Likely not quite yet. The low-hanging fruit is being picked in the order of how low it's hanging. So there might have been wells in Venezuela that were literally just ready to go that got fired up. Now there's other wells that need workovers, and then that crude needs to be processed. So as those barrels keep getting added, the sophistication of what they need to do keeps getting more and more as well. So we shouldn't just use a straight line kind of, if they added this many barrels in the last 6 months, then they should be able to add this. It's not how the oil industry works.
Skilled labor is a major choke point.
Yeah, skilled labor, pipelines, compression, refining. There's a lot of issues there, along with, of course, social issues, meaning you can't just pile billions of dollars into the country if you don't have a stable climate where people are not going to go and bomb stuff or hot tap pipelines and trying to steal stuff. So that's on that side. The rest is really just a wait and see game where we have OPEC Plus and we've got Shale. If those two factors are working in the bulls' favor, we have a market that's slowly draining the excess inventory that it doesn't want to pay for the cost of carry to keep, and people don't want to retain inventory. Great, dump it all in the market, because we're going to see this, let's say, 2 million barrel per day draw for how long? Saudi Arabia is going to let it go until you're getting to really, really low amounts of barrels that are left on the market. And at that point, they are 100% in control of the market, barring US shale growing, which, of course, the structural thesis is saying that shale, let's say shale at $120 oil can grow. It's not growing 1 million barrels per year. So the just a regime change has been dramatic. And depending on where things go from here, I think it looks like Saudi Arabia in the next 6 to 12 months will be in complete control of the market, at which point they can decide to add barrels to what they think makes sense. Let's be honest here, if crude rises too much into the 2024 election year, there is going to be geopolitical blowback. How exactly Saudi wants to deal with that, we'll see. I think saying that the price is just going to drop again into the 70s or the 60s is not a reasonable way to look at it. We have to see what are the inventory levels and what is the undersupply or the oversupply as the time continues on. I don't think Saudi will let the price ramp up way too much, and then refuse to add barrels to the market. I think they will have to play this very, very carefully, because last year they were late by about 6 months, in terms of, well, last year they were late by about 6 months in terms of unwinding their cuts. I think the cuts were unwound too fast. And then this year they were late by 6 months in reinitiating those cuts. So what are they going to do now to play this market very effectively? Because on top of all of this, you have the big unknown. And I think it's a known unknown. Some people may argue this point, but Chinese and Asian petroleum demand continues to rise. So, you know, you can throw your manufacturing numbers at me. You can say the property is down 10%, whatever. The reality is the petroleum consumption keeps rising. And that's not just China. Because China reopened, you're seeing flight routes restart into Australia, into Japan, into Korea, Thailand, Singapore, Malaysia, Vietnam, Indonesia, massive population centers into India. You see a large part of the population here that's now coming back into the market. And there's going to be a lull. Like America, once it reopened, had this lag effect where certain people didn't want to go out for another 6 months. They still wanted to wear masks. They still wanted to travel within their little groups. And that takes time for the entire population to get back. It takes time to retrain the airport staff, et cetera, et cetera. So we're going to see that play out on the top of all of this so-called demand weakness in America and Europe because of the higher interest rates, which again, there's not that much data that's showing incredible demand weakness. There's certain parts of the sectors that are showing maybe certain weaknesses, but in terms of raw petroleum demand, we are still looking really, really good at this point. So to answer your question in a very long way, I think Saudi's going to drain the markets to the point they're happy with the inventory that's left. Then they will go in and really take control of sort of the month-to-month movements, depending on where they see demand going and depending on where they see supply being added in the rest of the world from then on.
Yeah, they certainly looks like they're setting themselves up to be in the driver's seat to keep oil in the sweet spot. I mean, it doesn't really, it's not convenient for anyone to have oil in the, you know, $140, $150 a barrel for too long. You get that demand destruction. But I mean, at the end of the day, when you look at a lot of the companies that I look at, you know, guys, we're at oil's at $80, $81 at the moment. It's not the end of the world. Like, you're still getting double-digit free cash flow yields in a lot of these companies. So we've set up this supply drain, demand continues to grow. And if you look at the CAPEX with the graph I'm showing now, these companies are producing a lot of free cash, and yet their reinvestment rates, be it, you know, it's basically maintenance CAPEX and no more. Eventually, we're going to need capital to flow into this sector to produce the oil, because we're not stopping oil consumption anytime soon. Where do you think that CAPEX is likely to go into some of these small producers in Canada that you've got your eye on? And I want to fly through this because if you look at where some of this production segments have changed, a lot of it seems to be less conventional, certainly less growth from shale that we mentioned. And we're starting to get to this point where more of this production is being accounted for from offshore and some of the heavier sands plays. What's your view in terms of, is there a hierarchy of where the capital will flow to first? Given that, I guess, what happened in 2020 with the whole basically bankrupting the entire offshore sector except for Transocean, that restructuring meant now the break evens on these things offshore are a lot lower than they used to be. They're almost on par with some of the onshore Middle East. Where do you see the capital kind of flowing, given some of those data points that I just mentioned?
Yeah, I think excellent question. So just to wrap up the macro, I do want to share a couple of data points.
Go for it.
The oil on the water. So when you look at floating storage plus the oil in transit, that's your oil in water overall. That is down roughly 75 million barrels, 75 to 90 million barrels in the last 3 months, let's call it. So the initial inventory drain happened on the oil on water, as you saw less barrels being exported, but the imports stayed the same because the ships were reaching the destination. You saw that number slowly dwindle down to the point now that we've lost about 75 to 90 million barrels off the market. in the last 3 months. A quick add-on point to that, when Saudi Arabia decides to re-add barrels, when Russia decides to re-add barrels, you now need to fill up your oil and water first before that oil ends up onshore reaching somewhere. There's going to be more barrels on the, yes, tanker rates, tanker barrels, more usage of these of these ships. So the reaction time between barrels being added to them actually ending up as usable barrels at a refinery, there's a lag there. There's a 6 to 9 to 12 week lag there that we have to be cognizant of as this market continues. Secondly, there's about 70 million barrels onshore crude globally that's been drawn in the last 5 weeks. So 5 weeks, 35 days, 70 million barrels, you get your 2 million barrels per day undersupply right now that we're running into. And then as the refining capacity catches up, we'll kind of see where we end up on the crude plus products draw. But right now it's looking like the onshore crude is drawing at that 2 million barrel per day rates, at least for the last 5 weeks of data that we have. So that's that. I will continue sharing more on that as time goes on. And then as to your question, where does the CAPEX go? So let's just be completely blunt here. There's only 2 places in the world where you can add meaningful barrels. One is your deep water offshore. So not your shelf, not your shallow water stuff, your deep water offshore big discoveries. Yes, there's stuff in the continental shelf and the shallow waters that's going to add few barrels here and there, but really you're decline mitigating. That's all you're doing in those areas. In the deep water offshore, you're actually growing your number of barrels that's coming from that. You're seeing very high impact wells. For the bulls that are maybe getting a bit worried that I'm saying this, just keep in mind that the offshore wells take months to drill. You have to do a lot of delineation. Then you have to decide if an FPSO is worth it, a floating production and storage platform, if that's worth it. And then it takes about 3 to 5 years after that for that first oil to hit the market. So if you're in an offshore service play, that's great for you because that means more days that rig is on site drilling those wells. So it's kind of a win-win where on the service side, it's looking good. And then as an oil bull, you say, okay, I have really good line of sight to when those barrels are going to be added because it can't just be added tomorrow. That this process has to play out. And we're seeing very, very early so far indications out of Suriname, out of Namibia. We're seeing some projects go through in Nigeria, Angola, and then the North Sea looks to be pretty tapped out. So, you know, there's only a few areas in the world that we have to track to get a good idea of global deep water offshore supply. The second place where projects can be added, low decline, meaningful production, the Canadian oil sands. And guess what the shareholders and the government is telling these producers to do? No more CAPEX, no more big projects. We don't want any increase in growth. We don't want any production growth at all. Great, keep pushing this narrative because the Canadian oil sands is the only place in the world, like I don't even think deep water can do this. The only place in the world you can add, if you said by 2030, I need 5 million barrels of supply, the Canadian oil sands is the only place in the world that can do it. And right now they got their hand right on the neck and they're choking this thing out. So we'll let it stay like this. I got no problem with kind of keep pushing this narrative because we don't want more supply out of the Canadian oil sands. And it doesn't look like there's going to be more supply out of the Canadian oil sands. So that's the 2 places where you're really looking for big CAPEX to go into. Anywhere else, I mean, we have Iraqi onshore, we have Iraqi offshore, or Iraqi onshore, we have Iranian onshore, and then we have Saudi and UAE offshore, where you can add barrels. But again, you're fighting declines. You're fighting declines in your 50, 60, 70-year-old legacy conventional onshore fields. So it's not entirely adding barrels. It's more so making up for a lot of the barrels and then maybe some growth on top of that. And I will say the graph you posted earlier, the one with all the lines up to 2025, you can see in there, it's showing shale also continuing to grow. What happens if those barrels from shale don't get added? Now you have a bigger undersupply than people thought. Or think of it this way, if the supply response from the world is more than we thought it would be at a higher oil price environment, but the shale barrels don't show up, you're in the exact same spot that we're at right now, looking at a structural bull cycle. So I think there's a few interesting comments I've seen that your analysis is completely wrong, because at a higher oil price, the supply response will come. Okay, well, if it will come, what if the shale supply response that everybody is baking in doesn't show up?
Yeah.
So we really need to look at these things not from a one-dimensional way, but from looking at all the different factors that are going on. And at the end of the day, we're all playing the odds, right? Nothing here is 100% or 0%. We're all playing a risk reward, a expected value estimation. And I think the odds, if I'm playing on a roulette table, and it's like playing with 30 of the spots being red instead of 18 of them. So I'll play my odds like that all day long. I'll sit at the table all day long with patience. Way to look at it. And keep sipping my drinks.
Absolutely. That lag factor you mentioned it's a decent lag, and it's super underappreciated, isn't it? When you think about it. To kind of wrap up, we speak about supply because it's easier, I guess, to keep track of barrels. Demand can be a little bit more volatile, because who knows what can happen. You can have a COVID style event. But this is another graph from your Twitter, which we've spoken about before. We've got population growth in emerging markets and energy growth consumption in those markets, with those particular people's increasing energy consumption hitting their S curve. So is there anything you want to add in terms of, I guess the big one with regards to oil product is fuel demand? And talk me through this graph here and why it's so important for the oil narrative, and then we'll start talking about those Canadian names that you mentioned.
Right. Yeah, 100%. So few things in this graph. I just want to caveat, first of all, and say the 2.01 number is a half-year volume. So when you're reading that last comment there that says domestic sales expected to touch 6 to 7 million, that is going to be, you have to account for the fact that the graph is only showing half-year sales. Yeah. So the full year sales are already at 4 million, and then you're comparing it to that number. So this is a graph that got a bit misunderstood. I got a couple comments on it. So what do I really want to share here? So the first thing that I'm going to share is, look at the trend line. It fell during COVID, but it didn't stay at a lower trend line. It came back to where the pre-COVID line was going. Yeah. So, and we're still early. India just came out of the COVID waves last year, and then some of the international travel is just starting. Some of the people in the country are just coming out of kind of getting jobs now, making money, and really getting the economy back on track. So still beginning. The other thing is the raw number itself. So India currently, I believe, is the third biggest market for vehicle sales. The US is first at about 15 million sales per year. China is right now number one at about 20 to 25 million sales per year. India has 4. Well, we know the population of India is now the biggest population on the planet. So when you look at just raw demographics, a very young population, a population with many people moving from the middle class up, and then moving from the lower middle class into the regular middle class, you're seeing them moving from motorcycles and scooters into passenger vehicles, which is what this graph shows. So that demographic switch, you can see we have 4 million. China is at 22.5 million at the midpoint. There's about a 6x roughly growth here. As we get there, it took China 20 years to get to where they were from 2000 to 2020. How long is it going to take India? Well, we see that industrialization and modernization happens at a faster and faster pace as time goes on, because some of the technologies have been already much more efficient. People have a lot more money. People have the internet. They can go and see things. People are traveling a lot more. They're noticing what they want to do. There's a lot more opportunity for entrepreneurship. So every modernization is just happening faster and faster on that S curve. The final point I'll make here is half the price of gasoline in India is tax. So when you have a country that needs incredible road infrastructure, you need all these gas stations in densely packed areas with very, very high real estate prices. What do you need to do? You need to subsidize these to some extent right off the bat. As that volume grows, you can reduce the percentage tax on that barrel of gasoline or on that liter of gasoline that people are buying. So expect to see that despite oil prices possibly ramping, despite the Indian rupee getting weaker against the US dollar, the growth in the GDP of the country, the national income of the country, and then the affordability of the country still ramps up faster, especially if you can lower the taxes on the people. So if you were paying 100 rupees for a liter and 50% is tax, let's say it goes to 150, but now only a third is tax, well, you've ended up at the exact same, or sorry, not 150. You keep your crude portion of it goes up, let's say from 50 to 75, but the tax goes down from 50 rupees a liter to 25. You've essentially kept your price at 100 just by adding more sales volume and taking a smaller percentage cut of that volume. So expect to see this being a very bullish factor for not just India, but some of the other areas, such as Vietnam and some of the other countries in that area. But India being obviously the big one, where they report a lot of things on a day-to-day basis. And then the kind of the cherry on the cake is that India has its own refining infrastructure. So as the price of crude goes up, we usually see crack spreads rise, creating a demand destruction per se. But if you have your own refining, you're essentially absorbing that within your country and giving the consumer a tax break in that sense, because you have their own refining. And guess who they stole this model from? The US of A. So this model works. It's been proven to work. You want to have your entire chain of manufacturing, processing, refining, etc., transportation within your own country, because it really subsidizes the consumer in that way, and also allows you to have more geopolitical power globally, because you're not stuck relying on one country. Look how that turned out for Europe, and also look how that may turn out for the world if they keep pushing EVs with all their refining and manufacturing and processing being in China. It's a big risk to be taking. We've never taken this sort of risk before. So yeah, we'll see how it all pans out.
Fantastic. Fantastic answer. I didn't realize that point that you made, but being able to effectively scale back the tax while still keeping the same amount of, let's call them rupees, I was going to say dollars, but the same amount of funds in the aggregate hitting the government's coffers is, pun intended, potentially like jet fuel for demand, because everyone's winning at that sense. Super important point. I think, well, myself included, a lot of people were missing. I remember the first time we ever spoke, when I asked you where you were looking, you made the point that you were looking for places that were investing in their refining capacity and having that fully vertically integrated chain. So super duper important. Now, I just love this. For audio only, I'm pulling up the White Tundra portfolio as of June, and Shubham's personal portfolio. You and I are from the same school that completely ignores modern portfolio theory. We're looking at let's call it a concentrated portfolio. Two stocks I would love to get your thoughts on today. We've spoken about Surge Energy before in the past, and Prairie Provident Resources. I really want to dig into those. I notice a few out of the money calls on Vet and Obsidian, so maybe we can talk about that. To move straight into Surge, if we're looking at, yesterday I updated this, we're looking at an enterprise value 1.1 billion Canadian, market cap 795 mil. And yet, if we look at the reserves that this particular company has, do you use the P2 reserves? Do you use P1? Give me your thoughts on Surge overall. And then if I'm looking at, say, P2 at $80 WTI, you're looking at an NPV of roughly $13.34. So what's going on? Why is the market not appreciating this? Let's talk Surge Energy.
Yeah, for sure. So I'll just say upfront, Surge Energy does not work under $75 a barrel, right? And when I say it doesn't work, that doesn't mean that it's going to go bankrupt. That doesn't mean that they're going to go and start declining production. They have no money for capital. No, I'm speaking about on a public market standpoint. and what's attractive to people to invest in, it just doesn't work. It's a name that has exceptional torque on the upside. It has a relatively higher, let's say, cost of capital. And then we have to accept the fact that interest rates are going up. So people don't want to take risky bets. And then number two, if you're investing in a leveraged, indebted producer, the producer is paying interest rates that are much higher than they were for the last 5, 6, 7, 10 years. So when you put leverage on something, you inherently increase the torque on it on the upside and the downside. But you also add in that sort of payment that is affecting your inherent break even of the company. So under $80 a barrel, I just sat in Surge. I had no indication to move out of it because the price of it fell so much. It fell relatively more than its peers because of the inbuilt leverage, because of the inbuilt higher cost of capital, the higher break-even price, and just the fact that it's an 85% oil company. So it's really torqued to the price of oil as opposed to some other companies that are 50, 60% oil. But all of this works both ways. So the reason I'm investing in the cycle is not for $80 oil. It's not for $75 oil. And then anybody who tells you that they're investing for $80 oil, just ask them this question. Ask them, hey, if your company tomorrow came out with a news release that they've hedged their barrels for the next 5 years at $80 a barrel, would you keep that company for the next 5 years? Most people will say yes, but then as the price of crude ramps, that company will be the first one to exit their portfolio. So it's one of those games you can play, especially as prices rise. It becomes way more obvious the human nature aspect of that. So I think, given that I'm not investing for that lower end of the price range, taking concentrated bets in some of these producers that have that upside, that have that torque, I think is very important to me. Keep in mind that as the company pays off that debt, you're essentially getting that value coming back into the equity of the company, at least theoretically. It doesn't always work right away, but with some sort of lag on it, that is how things should play out. What makes Surge different? So when I look at my portfolio, the one you shared here in the last slide, there's a big element of free cash flow. Yes, we want the free cash flow yields. There's a big element of reserves right here. We're talking about 1P reserves, which I believe are about $14 a share, and then the 2P, 2.5 million. Subtract the 300 of debt on there, and you have that should be roughly $22 a share on the 2P reserve. So we're trading at 1/3 of the 2P reserve. We're trading at roughly 60% of the 1P reserve. We're trading at, call it exactly at the PDP reserve, we'll say. Yeah, here's a slide. So 14 and 22, yeah. So those numbers are great because they tell you you're trading cheaper than what the reserves are telling you. Okay. Now, a couple points that make Surge really special. Because they have a higher cost break-even barrel, as the reserve strip goes up, they have a excess impact from that. So you see this reserves are being calculated at $83 a barrel. For every $10 change in reserves, Surge will get a outsized bonus because their cost of capital or their cost of break-even is just higher. So let's say, and let me actually prove this point out. So let's say you have a company that has a break-even of $70 a barrel. Okay, you're running reserves at 80, so you're banking in $10 of profit per barrel. Now price goes to 90. You are now banking $20 of profit per barrel. So what have you done? You've doubled your reserve value per barrel. Not exactly. This is not exactly how the math works.
Yeah, there's some fixed and some variable costs, but to illustrate the point, yeah.
Yes, yeah. So cost of supply 70, from 80 to 90 WTI, you've doubled your profit per barrel and your NAV. Now let's say you have a low-cost producer that's break-even is $40 a barrel. So at $80 a barrel, they're making $40 profit per barrel. At 90, they're making 50. So they go from 40 to 50. They've only increased their profit per barrel by 25%. They've only increased their net asset value by 25%. So you can see how the higher cost producer gets the outsized benefit in terms of a percentage gain on the reserve values. So that I think is your one major point. The second major point is look at the map of what Surge has. The geology, number one, is top notch. They have the best permeability. They have a lot of good land that's conventionally developed without excessive fracking and freshwater usage. They have land that is very conducive to multilateral drilling. And then they have land that is very conducive to enhanced oil recovery, water floods, polymer floods, CO2 floods. So on top of all that, they have a lot of undeveloped land that they haven't developed yet. They've just left it there. They say, we're going to buy all this acreage. We're not going to produce anything because we don't have the infrastructure. There's nothing on that land, but there is wells close by to that land that show you the reservoirs there. They have run 3D seismic on the land that shows you the reservoirs there. They've drilled vertical test wells. They've taken core samples that show you the reservoirs there. It's productive. It can make oil. They just haven't gone and produced it. So as the price of oil now goes up, as the company's in better shape, they have a lot of opportunities here to go and put money into these things to add production, add reserve value, add net asset value, or possibly prove out a small play and then keep selling them to other companies that don't have the reserves or the inventory. So it's akin to you have a box of cookies in your fridge, and you also have a box of cookies stored up on the third shelf cupboard, and you have one in your cold storage in the basement that you're just leaving there and saying, I'm not going to bring those out until I really exercise my box in the fridge and really able to put maximum efficiency and optimize it. So now people may believe this, you may not believe this. The reality is it's going to show up over time. So once again, the scoreboard is out there for everybody to see. To me, I think there's a lot of undeveloped land in Canada that just hasn't got the right technical work done on it in the last 10 years. When you compare shale, where you got lots of innovation, lots of technology, lots of cheap cash thrown at it, Canada didn't get the same thing. So there's a lot of technology and especially enhanced oil recovery that still has to be done. And that's why I think it's been my top play for 2 years now, my top percentage holding, both in my personal portfolio and the White Tundra portfolio for just about 2 years. Maybe not quite, but roughly there anyways, because to me, I'm investing in higher prices, and at higher prices, I want the companies that have the optionality to go and do stuff with their acreage and their land. And I see companies out there with poor inventory that are going to have to buy. So there's a natural fit for the buyer as well. Obviously not tomorrow. I'm talking over a 12 to 24 month period moving forward.
When there's a bull market in cookies and people are
yeah,
are
exactly.
starting to reach into the basement. Well, we've seen M&A
yes.
activity, even in the Permian, really tick up. And so I guess when you look at it one way, hey, if you're buying something for roughly its PDP and you've got this massive call option on 1P, 2P, and then this extra acreage that hasn't even been touched yet, that's what we mean with Shubham's example about higher break-even costs providing torque to the upside. That's where the leverage is at.
Right. And then you add on top of that the company itself is leveraged, that you have about 30% debt on the capital stack. So you have the additional leverage on the entire unit as well. So
yeah, I mean, it really is akin to a call option without that theta decay, without that time factor of ticking, working against you. In this case, it's, if you believe in the thesis around the oil prices, it's working for you because you've got all these reserves. And as long as the company can service the debt, which at $80 WTI, correct me if I'm wrong, but they can just kind of just keep operations going without sort of moving forwards or backwards. We're waiting for that bull market in cookies. Now, speaking of balance sheet leverage, here's one that we've spoken about a while ago. When I was in Panama, we did a podcast. You couldn't talk about PPR as there was I believe, an NDA signed. So since I think 1 or 2 years ago, we've seen the balance sheet being restructured with PPR. Where are we at the moment in terms of this particular company? If you can talk about it. And talk me through this graph I'm looking at here, which is the restructure of the company. How do you see it moving forwards? We've got a target price, let's say, of 38 to 66 cents if you use the sort of P1, P2 reserves. And I just have a question around outstanding warrants and the risk for further dilution. So take your time. I know I threw a lot at you. Let's run through PPR and give me your thoughts.
Yeah, 100%. So I guess I can share some of the context around what happened here. So PPR was running about a 10-to-1 debt to equity. So we had 15 million of equity, we had 150 million of debt. Fantastic. This is going into 2022. This is exactly the name you wanted to be into as an oil bull. The problem, 60 to 80% of their oil was hedged at $63 a barrel. So as the price ramped up, the royalties went way high because the royalties are a percentage of oil price, yet the price that PPR was getting was basically $63 a barrel. So they ended up making less money than they would have if oil prices were just in the $80 range because they had so many barrels hedged. And essentially, the company got caught in sort of a pickle with lower oil prices into the latter half of the year, into the first half of 2023, and just ended up spinning their tires. I mean, when you got 150 million of debt, they were paying more in interest payments a year than their entire market cap. So it's just not sustainable unless you saw really high prices for about a year to let them get through that, or if they were able to sell off an asset when prices were high. So they had a lot of assets on the market in 2022. They weren't able to transact on any of them, just given the volatility and the pricing and the cash flow was just all over the place. I can't speak for the company, but that's my indication what happened across the Canadian market last year. So what happened about a couple of months ago here, they closed the restructuring agreement. So they turned half the debt into equity. The equity was converted at, I want to say 14 cents a share. So not at the market price, which was roughly 9 to 10 cents at the time. Prudential converted their debt at 14 cents per share. They ended up taking no warrants on that. They ended up converting their existing warrants also into shares. So the warrant side of the equation got cleaner. That's a 34 million share warrants, and those were absolutely a steal because those warrants, the strike on them was 2 cents. So if PPR had ran last year, those could have been like 50 to 100 baggers. It depends what price you want to say that warrant was worth when they got it. But they got it for free with the debt renegotiation that happened a few years ago. So could have been huge gain on that. They eventually converted them into shares, and here we are now with about a 6x on our fully diluted shares outstanding. It looks about a 5x actually. So you've really killed a lot of the torque on the upside, is what you would think as an equity investor. Like, okay, I've lost my torque, but let's just look at things step by step. So the company still has 50% debt, 50% equity. You don't find these names in the Canadian oil patch. There's a couple of Permian names that are running this sort of leverage, but on the Canadian side, there's nobody else except PPR and Saturn that is running this sort of leverage profile moving forward. The other thing is, because the debt came down significantly, they're saving about $7 to $10 million a year in just interest cost. So there's a big bonus to the bottom line because of the reduction in that cost. We also saw them have immense reserve value. So this company has, I want to say 600 million of 2P reserve on a company that's currently valued at about 150 million. 589. So the current EV is roughly somewhere in the $160 million range. So you can see we're trading just above PDP, but there's a lot of 1P and 2P. So now you might ask, why is there so much 1P and 2P? Why is it not in PDP? Well, when you're running a house and you have things that are breaking down, but you took on insane leverage on the house to buy it, you have no money. You can't even fix things. that are like a 15-day payout because the bank is calling you every day. Hey, I need my $10. I need my $10. So you can't do anything with it.
Can't fix
And
the
that's what
tap, the
PPR.
cupboard handles are broken. You gotta pay that
Yes. Yeah.
mortgage. Yeah.
Like everything is broken, but you can't fix anything, even the cheap, easy stuff, because you have so much debt on the corporation. So PPR was stuck in this for 3 to 5 years. A lot of their wells went down into PDNP. A lot of their wells, they weren't able to do much drilling, so they lost the reserve out of the PD. It went into some of the 2P and the 1P category. They weren't able to do their water floods. They weren't able to do their polymer floods. So the asset is just sitting there with all this low-hanging fruit on it and just no money to do anything with it. So now that the corporation is in a slightly better spot, we're seeing better prices. They haven't hedged any barrels. They've only bought puts. So the upside is completely open. It lets the company kind of, they're still not out of the hole. The hole was 5 feet deep. Now they're in a hole that's 2 feet deep. Well, as they come out of that hole, they have this insane jetpack on their back. That's just going to let them accelerate from there. So it's a patient game. It's a engineering game. It is a field operations game where we need to let them slowly build up the production base, slowly get back into drilling wells, slowly go in and implement their water floods. Then they go and they book more reserves. They move some of the 1P into the PDP. The production goes up, meaning the cash flow goes up, meaning they should have more cash to just keep recirculating back into their assets. They already have the assets, as you see here, on the 2P side. So a very patient story. It's got 50% leverage on it still. Love it. That's what I like to invest in. The bankruptcy risk has been significantly reduced with the restructuring of their remaining debt. And then the one completely X factor with this company, they have about $800 million of tax pools. So they have tax pools to the point they're not going to pay corporate income tax till 2071. In that
Are they
range.
transferable in the case of a buyout?
So there you go. Now, some people will say tax pools are completely worthless. It doesn't mean anything. Okay, fair enough. Say they're completely worthless and don't buy PPR. That's fine. I'm telling you the tax pools are transacting on the market. When I talk to people that say, I'm talking to the VP finance at a mid-cap E&P, they're saying, we think the tax pools are worth somewhere between 5 and 9 cents on the dollar. That's what we would value them for in a transaction. Okay, 800 million of tax pool, take the lower number, 40 million. 1/4 of your EV can be transferred. And the company could choose to keep, let's say, 100 million or 200 million of the tax pools, and they still would be non-taxable for the next 10 years. So they have sort of this optionality on here that if they're able to execute, I'm not saying they're going to sell anything. I'm not saying they need to sell anything. But when you look at the overall value of the company, they have this asset in place that the market is giving them zero value for. I put something like $50 to $60 million of value on it. Therefore, the company is roughly debt-free, and I have the equity that's now gonna, the value of the debt should come back into the equity once again in this case, and I'm gonna run with that model for the next 12, 24, 36 months. One caveat here that I will say, the restructuring came with a $4 million equity financing. As part of that equity financing, the shares were the shares were issued at 9 cents. So whoever put 9 cents into the financing, you got one share, and then you got a 5-year warrant. So that warrant, the strike price on it is 10 cents. 5 years is a long time to have a call option, which is what a warrant is. A warrant is a true call option on a entity that has this much PDP, and then this much 2P reserve, and the tax pools, and the production growth, and you have, as that debt gets paid back, the interest comes down further, the G&A comes down further, just more operational efficiencies as time goes on into a bull market. Hey, I'll take that warrant all day long. So we were a major participant in this restructuring financing, have the shares and have the warrants. So I just want to make that clear that my position that you see on the White Tundra portfolio, some of it was in legacy shares from 2022 and 2021, but I would say 90% of that is your the money we put into the financing, and got the
Right, the
shares and the
warrants.
warrants from that. So hey, I again will repeat this point: risk reward. This is not a 0 or 100 or black or white game. This is a what makes sense to me. In the case of PPR, participating in the financing was again like playing roulette with 35 reds and just one black. And once again, I'll play that game all day long. For people who are looking at this entity right now, make sure you think about the risk reward based on your entry price, and then based on what's going to happen as far as the warrant dilution goes going forward. The warrants are planned to be listed, I believe, as well on the exchange. So once those are listed, I think it will create another sort of liquidity there for essentially buying a call option on a 5-year term, which you don't get in the markets on oil equities anyway. I think the longest is 2 years, at least on the US side. Maybe I'm mistaken, but that's essentially why this company has become such a major part of sort of the White Tundra portfolio. Final point I will make: not only did the company not have money to do what they needed to do, they don't have a stable management team or board. So there's been numerous changes to the boards of directors. There's been numerous changes to the C-suite, and we now have an individual who's kind of overseeing this, who's been looking at PPR for 10 years. So Patrick McDonald, the interim CEO, has been with PPR right from the start. And I think this is a new, refreshed story. Not all of these work out, but when you have a company that not only didn't have the money to do what they needed to do, they never had the leadership stability to do what they needed to do and extract the value out of their assets. Hey, we're looking into a much better structural cycle here at a company that was left for dead, and the vultures were circling, and all of a sudden there was a lion came in and they killed the vultures for now, and now we'll see who's going to be feasting as the months and the years go by.
Very interesting. And I'll expect a tweet when these warrants come on the exchange. I'll have to take a look. So we've got what, 4 million warrants potentially at a 9-cent strike, 5-year.
Yeah. So it'll be, I want to say roughly 45 million warrants at a 10-cent strike. Yeah. That works.
Okay. Interesting. Now here's not such a nice story. I'm talking about Tamarack Valley. We've got an estimated value around $4.40. It was a very popular stock at one point. I heard Eric Nuttall talking a lot about it. It's had rather abysmal rolling 12-month performance. Talk me through what's going on here. A lot of people are not happy with the management. What are your thoughts with regards to Tamarack?
Yeah. So obviously the red-headed stepchild, shall we say right now, of the industry. Nobody has anything positive to say. As you mentioned, Eric has a big position. I believe the Canoe Fund may also have a big position. I don't entirely follow that one as closely, but really this is a name where everything has gone wrong. And when I say everything has gone wrong, I mean in the narratives sense. So they haven't done a good job at sharing the story. They haven't done a good job at explaining the acquisitions. They haven't done a good job at explaining the upside on what they have. The story is unclear. You have buybacks, you have dividends, you have production growth, you have acquisitions, you have debt payback. What exactly are you doing? We need some more clear understanding of where the money is going. It can't just be this willy-nilly thing. And you know what? The reason I like the example of Tamarack so much, and I like it being brought up so much, is because the exact same thing that I hear on Tamarack is exactly what I heard on Surge in 2021. Surge made 2 acquisitions: Fire Sky Energy, about 60 million, and then they bought Astra Oil, about 160 million in 2021, late 2021, mid to late 2021. And it was like, oh man, what's gone wrong with Surge? Why did they do these acquisitions? We don't know what land they ended up buying, what's going on. And well, bam, the stock got absolutely hammered in November and December of 2021. And then guess what? From December 24th to June 8th, it was up 200% in that meantime, by far the top performing stock over that time period, from the low in December to the high of 2022. Not saying the same is going to happen with Tamarack. Tamarack is a much bigger beast. We have a lot more barrels. We have a lot more shares outstanding. So you need that torque really to work with you if you want to see a 200% increase. But at the same time, what do you have here? You have an entity that's about 30 to 40% debt on the balance sheet. You have an entity that they've just bought 2 acreages that are producing the top results in the country, the top paybacks, and the top number of paybacks in the first year and in the first 24 months. And they're just getting started. The infrastructure was not built. There was gas plants that needed to be built. There was pipelines that needed to be built. There was oil handling, transportation that had to be done because they bought a lot of private companies, which means what are the private companies going to do? They're not going to build hundreds of millions of dollars of gas plants. They're gonna just build what they need to build, get the production jacked up, and then say, hey, look, we've delineated this. You can still increase production here by another X amount. Do you want to buy this? Okay, if you want to buy it, you got to put money into the facilities and the transportation and the pipelines and the gas processing. Okay, so when Tamarack bought these properties, they have had to put in some CAPEX to account for the growth that's going to happen. And that process has just taken a lot longer in a $70 to $75 oil environment than it would have taken in a $90 oil environment. So you may think that I'm here, you've kind of put me on record and then replay, because I'm literally saying the exact same thing. Is the White Tundra portfolio is based in geology, is based in good assets, is based out of free cash flow plus reserves. Companies that have that are going to outperform, in my opinion, in a bull cycle. Companies with tax pools are going to outperform. Companies with leverage on the balance sheet are going to outperform. And companies with upside torque to oil obviously are going to outperform. So when I run that screener tool, there's only 3 to 5 companies in the small to mid cap space that fit that profile. And then there's 3 to 5 companies on the junior space that fit that profile. So, and those companies are the ones that ended up in the portfolio. And that's why there's very little change in the portfolio over the last 12 months. It's been relatively constant because the companies have already been picked. They've been screened, they've been analyzed, and then they've been invested in. So what is going to take for Tamarack to change? I think that's the main question. And we need higher prices. We need a more aggressive buyback. We need them to prove out their well results, including the enhanced oil recovery in the Nipissing and the Martin Hills in the Clearwater. And that's going to slowly regain confidence in the name. What can accelerate that confidence? What can be the catalyst? Higher prices. If oil jumps to $100, people want leveraged high oil percentage producers. So that can accelerate it. In the meantime, this is again, not a company that works under $80 a barrel. It just doesn't work. If you're looking for good investments and you believe that oil is going to be sub $80, this may not be the name for you. This is not investment advice. This is my opinion. These names are inherently built for a higher oil price environment, not just because they have the upside torque, but because they have upside on the properties themselves that so far they haven't really accelerated. Because why would you? Why would you go and drill all your best acreage and your best wells and jack up production in a $72 oil environment? It just doesn't make sense. So as prices go up, we'll let these kitties purr and we'll let them show what they got. But again, this is a belief, right? You either believe what I'm saying here or you don't. And that's really the kind of the what makes the oil industry so unique is you can't get all the information from a balance sheet. You can't get all the information from a cash flow statement. You can't even get all the information from conference calls or a PetroNinja or well results. You have to make a inherent bet on what the geology is based on what you think. So reservoir analysis, well logging analysis, we have your core samples, you have your competitor analysis in the area. You have to go and look at that and then make a bet. Not every bet is going to be correct, but when it comes down to geology, I think that should be the base for the bets that we've taken anyways. And I'm very happy with Tamarack over a longer term period. In that sense, they need to get their marketing right. So trust me, the marketing here is atrocious. Nobody understands what the geology is. They haven't done a good job disseminating that, and they haven't done a good job sharing what the company business plan is in terms of what they're doing with the dollar. If those two things get fixed, you'll see a little bit of a momentum in the stock as well, especially after ARC Financial is able to get rid of their final tranche of shares that they got from the Delta Stream acquisition, which is the rainy cloud on top of our head in this situation.
Okay, interesting. So we're still bullish in the thesis on Tamarack, given its inherent torque. If any of the management of Tamarack happen to be listening, I'm willing to go in and provide some marketing and narrative consulting services that may help you guys out. And I promise I'm not an overpriced management consultant, if there is such a thing. So here's something very interesting. Let's say VET, Vermilion. I saw this when I was looking at your portfolio, and I'm thinking maybe Mr. Garg thinks there's going to be another run up in nat gas prices, and maybe this is a call on nat gas. Quick thoughts on Vermilion. We'll fly through it. And how worried are you about the windfall tax situation? That was a debacle on this thing. I think it was last year.
Yeah. So one of the most polarizing stocks in this sector by far. So I guess I'll make a couple of points. So am I worried about the windfall tax? Yes, at this point, it's something that's out there, so you have to be cognizant of it. Not just the current windfall tax, but is there going to be more windfall tax if the prices rise again into the future years? Europe has not solved their problem by any means. So they're still under this burden that they've taken on to reduce the world's emissions. And, by all means, I have nothing against it. And certain equities can benefit from that sort of thinking. So Vermilion, you see what happened last year, how fast it moved up and how fast it moved down. That is just the reality of this name, because, it's 80, 90, 100,000 BOEs, but all that really matters is the 15 or 20,000 European gas BOEs. That is your cash flow machine, upwards and downwards. So the October options were a bet on some of the lowering of the global supply of natural gas and some more competition on LNG from China, Korea, Japan, etc. So far, it hasn't played out. There's about 6 weeks for the option. Things can change very fast going into a winter. We all know that. At this point, am I super bullish on those Vermilion options? No, because I bought them way out of the money. I bought a 22.50, I believe, October call. So it's way out of the money. The way I played that is I bought that Vermilion option and I supplanted it with ARC Resources options that were more conservatively priced, which are making up for the loss that the Vermilion option currently is in. Actually more than making up for it by a pretty large amount. My other comment on Vermilion options, we are once again playing the risk reward game. The options last year that were bought in late 2021 were at one point up 950-ish%. Both of them, I want to say. So if I can win 1 out of every 3 bets, but make 950% on the one bet, should I be playing this every single year?
The expected
value.
Yeah,
probably. Yes. As long as I see that Europe has not solved their natural gas problem, I think this is a bet you will see in my portfolio every single year. An October option, and then likely something like a June or July option for that post-winter period, and likely going to buy it well out of the money. So probably 50 to 100% out of the money option, and take that bet as cheap as I can get it and just leave it be. I don't need to put a large dollar amount into it, because I'll supplant it with a large dollar amount of something more conservative in the Canadian space. So it's all I think portfolio construction is very important. I think your viewers know this, but when you look at my portfolio, it's not just bets that I've taken individually. There's some sort of secondary measure there. Not every time. Not every time do I end up ahead by any means. But taking bets that are skewed in my favor over time should work out in my favor. So I'm happy to kind of take those odds when I can get them. And I thought early in the summer was a good time for those ones, and we'll let it run. So we'll see what happens. If I don't end up making good on those, you'll see a June 2023 or June 2024 option in the portfolio, because things change very fast in European gas. It's like, just look up the torque and sensitivity on Vermilion on their presentation to $1 per MMBTU, and then multiply that by 30, because that's essentially your top end bull case.
Some of it, yeah, it's just cheap right tail event exposure, which, I mean, yeah, it makes sense. I've spoken about this with other guests on the channel. The infrastructure, the changes in European gas story, if anything, have gotten worse since that run up. So it's interesting. Here's one of my favorites. I don't know, Journey Energy, the management there seem to be doing a wonderful job, accretively acquiring assets, creating this huge, as far as I can tell, increase in value with regards to power generation. Maybe give me a minute on Journey Energy, and then we'll roll through a couple more before we wrap it up. I think this is criminally underappreciated. That's just my opinion.
Yeah, no, this is great. And a name that I think many people have not even heard of, despite the coverage that it gets on some of the retail platforms. So I think you hit the nail on the head. The management is excellent. The properties are good. They bought them very, very cheap. They have the power gen upside. We saw the recent transaction with Razor Energy. Power gen is selling for roughly $5.5 million a megawatt. Journey has 6 now, I believe, and they're building another 20.
From what I see in the news, it looks like Alberta could use a little bit more power gen.
Yes, 100%. Yeah. So I think, you can just run those numbers as to what that power gen is worth once it's fully online. Subtract that from the EV of the company. Not saying you have to run the math this way. This is how I would run the math. This is how I run the math for my website on the targets on the 8x FCF model. I usually subtract any assets from the net debt part of the company itself. So I think this is just a steady Eddie name. It's chugging along. They've got some good wells they can drill if they choose to go and really expand their drilling program. On the base, it doesn't have the greatest well inventory, but they have enough to keep going on. They have an industry low decline rate, so they don't need to drill that many wells to sort of keep their wells going, keep their production flat. I think this is one point that I myself have got caught with, is when you look at well inventory, how many locations does a company have? You have to compare it with the decline rate of the company. If the decline rate is 3x their peer, but then they have X amount more locations, you may still not be better off on an inventory standpoint. So it's not just reserves, it's drilling inventory that you have to keep an eye out for. So I think Journey in that case is doing really well. It's got a lot of shareholder support from high net worth retail, smaller family offices, it seems like, and even the smaller retail investors. So we're seeing names like that have outperformed over the last 12 to 18 months. Journey obviously being one of them. But I honestly don't have any crazy opinions on this company. It's 50% liquids, about 55% liquids, 45% gas. So you have optionality on both prices ramping, plus power gen prices ramping. It just continues to tick along, and it's got a little bit of financial leverage on it too. So I'm not surprised that it's a name that many like who are betting on higher prices because of the leverage that they took on with the Enerplus transaction, which was the other half of the Surge transaction that occurred.
Absolutely good management, low decline, decent inventory with power gen upside. That's why I like it. Now, to wrap up, we'll go a little bit left of field. I'm showing a graph of 2 LATAM producers that I own that I really liked, and I received so much crap about this when I first started talking about Petrobras and Ecopetrol, two let's call them nation state owned, majority owned companies, fully integrated producers, refiners, exporters, all the rest of it. If you look outside the US and outside of Canada, or first of all, do you like these names? If so, why? If not, why not? And if there's anywhere that you've got your eye on outside North America, be very interested. I've spoken about offshore a lot. Well, guess who's contracted a hell of a lot of those deep water rigs? It's the PBR boys. What are your thoughts on these two, mate?
Yeah, so PBR, obviously, again, a very polarizing company. It got brought up
Apparently, yeah.
probably 6 months ago, somewhere in there. Obviously, people had the company legacy. I don't doubt that, but it really came into the limelight, let's say, at least into my exposure, 6 or so months ago, and I heard both sides of the argument. I went and did my own research. Petrobras, I will say, is very transparent. They tell you everything. They tell you when the FPSO is coming online, what it's going to produce, where they are in terms of drilling that FPSO wells. They show you their finding profits, margins, everything. Their production sales report is the most detailed out of any company of that size that's out there. So the information is out there. If you are not putting in the work to reading these things and really understanding what you're buying, yet you're going and making bearish arguments on things, maybe you should be looking at doing the work first and then going and doing the debating or the arguing. So the company itself, here's the fact: it trades at a 1/4 the valuation of ExxonMobil. Roughly the same production, roughly the same refining capacity. They have roughly the same growth prospects. Exxon has Guyana and the Permian. Petrobras has your pre-salt basins. So you have a very similar company out there. It's trading at 25% of the valuation of ExxonMobil. That's it. Now you can say, I don't like Petrobras. I don't think it's a fair company to invest in. I think it's a scam. Sure, but it's trading at 1/4 of ExxonMobil. If it was trading at the same valuation as ExxonMobil, I would be here saying that I'm bearish. I'm not going to buy this company no matter what. But risk reward are our buzzword for the podcast.
Absolutely.
What valuation discount to you is appropriate for a company that does the exact same thing in a political climate that, again, I'm not going to pretend to be some sort of Brazilian expert. What I know is they are now listed through the ADR on the US exchange. They don't want to blow that up. They are a country that's consuming a lot more petroleum, gasoline, diesel, food. They're really an emerging market. Do they want to screw up their reputation on the global scale? We don't know. That's going to be something I'll leave to people that have done the full DD. To me, if I'm taking on that risk and I'm buying something at a quarter of the price, I will take that bet. So why am I not in Petrobras? Because I'm not comparing against ExxonMobil. I'm comparing against the small to mid caps and the junior names and the private placements. So when you now compare Petrobras to those, maybe the valuation gap is not as big, or maybe the valuation gap is actually doesn't exist because some of the Canadian juniors might have a bigger growth profile, or they might still be trading cheaper because they've been left for dead. So my investment universe is just different. But if you're somebody who's looking into the bigger names, the blue chips in the US, the Permian boys, I think I personally am very bullish on the valuation. They've stuck to their guns on the dividends. This chart doesn't even show the dividends that they've given out, does it?
No,
so
but they are
yeah,
juicy, let me tell you.
Yeah, exactly. So people look at the screen on their iPop and they think it's a scam. Well, if you go through life that way, then you're going to protect yourself from losing money, but you're not going to make any money. So why are you in the markets to begin with, right? Like that's my theory on it. I realize I'm a very you and I, Ben, are very call it edge tail investors. We're not investing in the regular investment kind of
we'd definitely get fired as like institutional managers, like pension funds would never hire us.
yeah, the guy that meme where they throw the guy out of the window. So we'd be that as soon as we bring up a Petrobras. So Yeah, so that's kind of my thoughts on it. I have no issues with people investing in this company. I don't know enough. I haven't done enough work to figure out what exactly the valuation gap is. All I can say is the pre-salt reservoirs are working. They have a lower decline rate than what they were drilling before. They should be able to meet their production targets a lot better. Why do I know all this, or why am I tracking all this? Because Brazil is a major player in the oil macro supply going forward. So who controls most of that supply? Petrobras. So in a sense, I have to track what the company's doing to keep an eye out for global oil supply growth going forward. And in that, I'm pretty convinced that the company has the reservoirs, the company has the wells, the inventory, they have the money to do what they need to do. The valuation gap is there. The geopolitical risk is there. What valuation gap is acceptable to you to invest in, given the inherent risks that are present in this sort of situation? And that's essentially Petrobras and Ecopetrol in a nutshell. Yeah, so I guess I'll leave it at that.
No, sounds good. Great. I might mention a book, Marco Papic's book around geopolitical risk. And look, it's almost, or statistically, it's almost always overblown. Essentially, you're looking at, okay, well, yeah, the arguments were, Lula, Gustavo Petro, they're both communists. And they were going to nationalize. Well, if in the case of Ecopetrol, there's only a tiny amount of stock that's actually available on public floats anyway. And Petrobras is already has a majority ownership of the Brazilian government. So, I mean, they're essentially anything messing with the dividend policies, like all these arguments didn't make sense when you think that these two companies are the cash cows for their respective governments. So that's the way that I looked at it. I guess we'll see how things turned out. Nothing more enjoyable than doing due diligence on Brazilian and Colombian names, but that has nothing to do with oil. We'll leave that maybe for a different type of podcast. So if we, mate, as always, cracking podcast. Is there anything you'd like to leave us with before we call it a day?
No, I think I'm very happy to see some of us oil bulls are still out here. We were an endangered species in February, and then we almost went extinct in May. So I'm glad to see that we are getting some support here from thanks to Saudi Arabia, of course, and thanks to the U.S. policy of trying to hamper their own oil production with some of the moves they did last year. So I think it's just good to keep the conversation open. I will say that keep an eye out on U.S. shale production. It's going to be a major factor going forward, and keep an eye out on international jet fuel going forward. So this is a part of the call it global petroleum mix that is going to not be impacted by recession. So the recessionary forces are nothing compared to the reopening forces and the global growth in international jet fuel that was already taking place in the 5 to 10 years before COVID happened. So there's a part of the market that is completely outperforming the kind of the global estimate in terms of petroleum demand going forward. So I think I will sort of just say, hey, watch the data, watch what's happening, keep an eye out for the lag effect. Don't be fooled by, oh, this EIA report didn't impact oil price, or this OPEC news release didn't do anything. Like, how do you know? By the time that oil is produced out of the well in Saudi Arabia and it ends up on the coast of China, it could have been 3 months. So it's impossible to make conclusions right away as to what's happened. So the respect the lag effect, I'll say. And then my final point I just want to make, a kind of a self-promotion, is I talked a lot about well logging, petroleum analysis, reservoir analysis. So I'm going to be running it back, and I'm going to be sharing a very, very long session on the petroleum engineering topics that I learned in my undergrad, kind of bringing it back and doing a 6 to 8 hour kind of session. It's going to be my regular Sunday session, so no cost or anything. It's going to be as is. But I really want to, I've kind of shared a lot on valuation. I've shared a lot on free cash flow, on well results, and I'm very happy to see people that are actually doing the DD themselves now. So I think the next step is, hey, here's how you read a well log. here's how you do a well by well net asset value analysis. Here's how you run sensitivities on should we drill this well or not. Here's how you run a sensitivity on a water flood, and really share some of the core engineering topics. So anybody that was listening to this and saying, oh, well, he's just talking about surge and PPR and why should I believe him? Well, I'll tell you exactly why. And some of those will be examples from these companies so that you can see in a real world aspect why I'm bullish on these things going forward. So don't exactly have a date planned, but hopefully here in the next month or two, get that out there as well. So yeah, as always, it's a pleasure, and we'll just keep sharing and democratizing the information in this industry.
Absolutely. That's your expertise is what you're known for. Let me know and I'll certainly share it around. All right, guys, we got to wrap it up. Thank you very much for listening. For more info into Shubham's work, details will be in the description as always. Take care, guys. Do your own due diligence, and I look forward to catching up with you in another video, hopefully soon. Take care, guys. Bye.